people. Hope you're all doing okay. This is going to be a bit of a random one, to be honest, but I think it's going to be a good one. So a good learning video. Might be a bit longer than normal, uh, but that's fine. So if I start rambling, then bear with me. But what we're going to talk about is we're going to talk about. I want to try and give. I think the whole purpose of this channel is not to be another. Just I don't want to be another person online that just shares wins, gives a little breakdown, and you watch it, and then you see the win, and then you've got nothing. You've learned nothing from it really. You've got nothing to take away and go and like look at yourself um, or you can't go into the charts and look at yourself because you don't understand it fully. So I want this channel to be like a, I want to share what I've learned, not look at the wins look at the wins I've taken, look at the payouts I've taken. I don't want to be like that. I want to share what I've learned over my 5 years of trading and give you something to sort of take away, and just little bits at a time, just give you something to take away and get you thinking, and maybe you go away and practice it. I mean, it might not be for everybody, but if I can reach out to if 100 people watch this video and just one or two of them take what I say and go away and practice it, then that's good enough for me. But I want it to be about what I've learned, the mistakes I've made, because I'm not a great trader. I'm not a full-time trader. I'm still working a 9 to 5 job, and trading when I can. So I'm still on my path to becoming full-time. Um, but I've learned a lot along the way, and I feel like there are some gems in there which people can take away. So I think we're going to start right at the we're going to start at the basics. Basically, I'm going to give you, because I talk a lot about the range cycle, and liquidity build-ups and stuff like that, but I talk a lot about that. But I want to, rather than just going into the replay tool and start back testing, I want to give you something for you to go away and you can do. And the best way to learn to trade this way, and to learn to trade liquidity and ranges and build ups and inducements and all of that stuff, is to do it in hindsight, is to see it in hindsight. Train your eyes. You have to train your eyes to see it, and then you can start doing the back testing tool, and then you can start trading live. But first of all, you have to train your eyes to be able to see it that way, because we do look at structure differently to other people. And you know most people would have been through so many YouTube videos and so many different strategies on supply and demand and smart money concepts, and um, support and resistance and trend lines, and all of these common retail strategies. A lot of people would have already been learning all of that, and maybe they trade some of it, and you have to teach yourself to forget about what you've learned, and forget about what you've learned, and sort of learn to train your eyes to see it a different way, because it is different. And a lot of entries can seem very random to some people, but when you start looking at liquidity and how markets really move, and how they do build liquidity, induce liquidity, and then run, it doesn't seem so random to you in the end. So let's go to, what are we on? Pound dollar. I want to go to, let's go to euro dollar. So euro dollar, let's take just a random range. Let's forget about the context of everything and just focus on the range. Just focus on a simple range. And let's go to, let's just find a range. So we've got this low, this high. So we're just going to take a range that's played out. And this is what I did when I first started, when I first learnt this way. Literally forgot about everything else, and I just found a range, and I broke it. I broke down the range and saw what happened inside of that range, and then it starts to make sense. So if we just focus on this range right here, okay. Now I should point out the whole theory behind the range is that we come and take internal range liquidity, and then we come and take external range liquidity. So we know once this high has been created here, we know that what we know, and we've broken structure. Oops, sorry, wrong button. We've broken structure right here. Then our logic, the logic we use, is we're not looking at this like everybody else, saying, okay, this is a break of structure to start going, to start maybe pull back into here, smart money trap, and then we start driving down. We're not looking at it like that. We're looking at structure in the form of ranges. So if we have a strong low and we have a weak high, we're all we're doing, once we break here, we're looking to take internal range liquidity, and then once we take internal range liquidity, we're looking to target external range liquidity. So there's our targets. That's it. As when you talk about targets, that's it. We've got two targets. We've got internal range liquidity. Are we coming for internal, or have we taken internal and now we're coming for external? So that's it. We have internal or external targets. But so the whole logic behind this range is that we come and take internal, and then we come and take external, and that's it. And we have some rules that we follow. Okay, if we're bearish, we expect strong lows to hold, strong highs to hold. And if we're bullish, we expect strong lows to hold until the target is reached, which would be this up here. So just keep that in mind. Now let's drop down to the 4 hour. So we have this range. We know it plays out because we can see it, but we're going to break down how we got there. And I think this is what you should do. You should find a range and you break down how we got there, keeping in mind that strong lows should hold if we're bullish, and strong highs should hold if we're bearish. Okay, so we look at this in a range. Let me move this over to here. Get rid of that. Move that over to here. Let's get this whole range inside of this. Okay, so if you remove everything, this just looks like this is just like, okay, we pushed up, we pulled back, and then we pushed up again. That's what it looks like to a lot of people. But if you take the logic of internal and external, and the range cycle and the build-ups of liquidity, and you start breaking it down, what really happened in here. So let's get into it. So we can see price took out this. Okay, we took out this low right here. Okay, what did we do? Once we took out this low, we pushed up. Now you ask yourself, why did we push up? Well, if you look at this in the form of a range, and we've broken structure right here, once we break structure here, our target is internal range liquidity. And this was internal range liquidity. So at this point, we are bearish, expecting strong highs to hold. And you can see, I mean, it's not the cleanest, but you can see that we have a strong high, weak low, price pushed up. We mitigated this breaker block in here, and then we pushed down, took external with this range, and then we created another range from here to here. And you see we actually came and took this internal right here, and then we went to take these lows again, and then we started to push up, and we broke here. So we start creating bullish ranges. We'll get into that. I'm going a bit too ahead of myself, sorry. We'll get into that in a second. But at this point, when price is broken structure here, we are bearish, targeting internal range liquidity. Not expecting this to get taken, but we're expecting price to come and take internal before coming to take external. And why did it? You got to ask yourself, okay, that's fair enough, but why did it come into this block and not take this as internal range liquidity? Why did we just this this is internal range liquidity inside of the range. So is this. So is this. You know, we could come, price could have come all the way down into here, taken that, and then drove up. And you have to put it all together. So you have to put, that's where order flow comes into it. So if you, this is a little bit messy over here, to be honest, but if you follow order flow, right, follow an order flow. Okay, this is this candle here. This candle here ran this liquidity, right? So this was the candle that ran liquidity. We pushed up, price pushed up, and we came back to mitigate this candle right here. Okay, and so this was the unmitigated candle. This was the candle that came in to mitigate this. Let me do this in boxes, actually, it'd be a little bit cleaner. So we had price pushed up, came back to mitigate this box right here. We do it in a grey. Let's do it like that. Price pushed up, came back to mitigate. Okay, then price pushed up. What did we do? We came back to mitigate. Well, we came back to mitigate this whole block here. And then what happened is price pushed up and we came back to mitigate this whole block here. And then what happened is we pushed up and then we came back to mitigate right here. So this was the candle. And then what happened? We pushed up, we came back to mitigate this block right here. That mitigated this. I hope you're with me. And then what was the last unmitigated area? This block right here was unmitigated. So let's just look a bit deeper into this. This was the candle that came in to mitigate this block, and then price pushed up, and we pulled back, but we never mitigated this block, so we never filled this imbalance. So this is, I use imbalances, I use mitigation, I use order flow, and you know, this was the, like I say, this was the last unmitigated area. So follow an order flow, price needs to come back and mitigate this block. And you can see it did it perfectly. And that is why this is a valid POI. Now, for some people, they might not be comfortable taking an entry direct from here, you know, because they see all this. They see all this down here and they don't trust the order flow is going to play out. And they see this as liquidity, so they might not want to take this. And that's fine, you know. Sometimes I take it direct and sometimes I wait for confirmation. But the problem is sometimes you don't get the confirmation. Like here, it wouldn't have given a lot, but yeah. So you can understand, like, this is why this was internal range liquidity. This is why this was the perfect POI, because it was an unmitigated block following order flow. And once we tapped into here, you can see we just pushed bullish and we went to take external. So you can see the logic behind the range, right? We create a range, we come and take internal, we feel some imbalance or some order flow, and then we push up and we take external. So you can see the logic behind it. You know, it's like people trade a lot of different ways, and I know that I like to trade with logic. So I like to, like, for me, this makes sense. You know, it makes sense to come and take out all of this. If price wants to build liquidity, if price wants to trap people, what's it doing here? You know, it's trapping people into long positions. And if price wants, if it wants to go a certain way, it needs to come out, get people out of those positions, and then go long. And look what it does along the way. Well, as it's coming down to get people out of short positions here, it's building more liquidity. It's just building more liquidity. Everybody's trapped. You know, there's people trapped in longs, there's people trapped in shorts right here, you know, putting their stops above here. So on the way down, it's building liquidity. And that's why strong highs hold when we're bearish, because at some point they become liquidity, they become weak. And yeah, so you can see what's happening. You know, you've got You got people getting trapped in shorts and longs here. You get people trapped in shorts here. Where's the target? Where does price really want to go? It wants to come and take external range liquidity. But for price to do that, it wants to be it wants to go there, but it doesn't want anybody on the train with it. So the best thing is to trap people in longs, trap people in shorts, and then what happens is take everybody out of the longs and then take everybody out of the shorts. And all we've done is generate liquidity on the way back to give price a reason to come and take this. And yeah, so you can see the logic behind the range. Like a lot of people trade in a lot of different ways, like support and resistance and supply and demand, and you know, they're sat wondering, well, why did this support and resistance area hold? Or it's because there's no logic behind it. There's no logic behind it. You could draw a line on a chart anywhere on a chart, and say for example, I just draw a horizontal ray right there, okay, and I scroll out, and you can look at this, and you can go, okay, well look, this is support, term resistance, this is support, price respected this right here, price respected this right here. You could draw a trend line on a chart just like this, just a random trend line, okay, and you can move it about like this and go, look, okay, well look, now we've got trend line liquidity here, so we get in on the first touch. It doesn't make any sense. It doesn't make any sense. Like there's no logic behind it. Whereas with liquidity and with ranges and internal and external, it makes sense. It's logical. It's logical what price is doing. And yeah, so it makes sense what price is doing, and you can see it in hindsight. You might only see it in hindsight to start with, but once you see it enough, and once you mark this up and you screenshot it and you put it in a journal, after you start doing 50, 100 of them, you won't look at the market any other way, because you've seen what really happens, and you've built that confidence in it, that you kind of know how price is generating liquidity, and you won't get trapped in long-term shorts in here expecting this low to go, because you understand the range cycle. You understand that you're inside this, you understand that we've just taken out internal range liquidity, so you won't start shorting from here, and you won't start shorting from here as price comes in, because look at this is a beautiful clean block. We had a very impulsive move to the downside, and this is a beautiful clean supply demand zone and smart money zone. And what happens is they get into a trade, they get a small reaction, and then they get taken out. And that's what price does. It just targets strategies. And if you look inside of this, I mean, what have we got? What sort of strategies have you got here? You've got trend line traders, getting in on the third touch, going short again, and then you have support and resistance traders down here. You have supply and demand traders getting the smart money traps up here. Smart money traders getting in here, and they go, okay, well this is the extreme, but maybe they've taken the decisional first, and then what happens is they go, okay, I lost on the decisional trade, I took a short in here, I lost on the decisional trade, so maybe I was wrong, maybe we take it from the extreme, and then they get in short again, and then they get taken out. And it targets strategies. I mean, look at this. If you put a box on here, that you have support and resistance. People getting in on of this reaction. Look, we broke out. Now we got failures. We got a fake out, and then they start getting taken out. You have breakout traders. Look, you have breakout traders all getting in. Once we break out of here, you have breakout traders all putting their stops above these highs. You have break and retest traders all putting their stops above these highs. Look, they're in a great trade coming down. they're in a great trade coming down, they think they're in the money. What happens? They get taken out. So just target strategies, all these common retail strategies are all inside of this range, and um, it's up to you to identify that how liquidity is being built, and yeah, and it's up for you to identify that and not fall for the traps, and you do that by understanding the framework, which is the range, internal, external. Now, it's not always that easy because, like this, for example, you might have saw price tap into here, you go long, you get taken out. Sorry, you get into a long position here, for example. You get into a long position here, for example, as it comes back, thinking this is it, we're going to go. And then price comes and takes you out right here. Respects this POI, but comes and takes this out right here. So yeah, it's not always that simple, but we respected this POI, but we still got taken out of the trade because we got in too early, and that's when so you have to be aware of traps, because look, all we did is we just built liquidity, inducing people, and then we took it out and then went along. So I don't want to say that you should always wait for price to tap in twice or anything like that, because that's not always the case, because sometimes it would go on the first touch, sometimes it would just tap in and then go, and you'd be in a great trade. But maybe you could have your stops below this POI, something like that, because price can come into these POIs as much as it wants. As long as it doesn't break it, that's fine. But yeah, price is always going to induce people into going longs. Even liquidity traders. You're going to see this liquidity get taken. You're going to go long, thinking you're in a good trade, thinking you're in a, everybody else is out of their positions, you're in a great position, and then you get taken out and you're left thinking why. But it's always going to happen, but it's just whether how much risk you want to take. I think how much you want to do. You want to try and catch Do you want to try and catch a really small move with a really small stop and risk getting taken out because price came back into this POI, or do you want to do something like that, cover the stop, cover the POI, and then start driving higher? So I hope that helped, and it wasn't just rambling. I think if there's if there's anything to take away from this, it would be to go away and do it yourself. Go away and look at a chart and just any time frame. Doesn't The time frames do not matter. Like that's another thing that took me a long time to. It's taken me a long time, and I'm still not great at it. Is treating this 4-hour time frame just like you would a 1 minute, because say you take this range, strong high, weak low. Okay, so you take this trade in here, you take it right there. You put your stops there, for example. You target these lows right here, you catch a nice winning trade. This is probably going to take 3 days, 4 days to play out, but it's the same range as if you go to the 1 minute. I can't go back that far. If you go to the 1 minute, let's find one. Let's find a clean one. It's the same range as this. Look, we have a run of liquidity, break of structure, we have a strong low, push up, we have a run of liquidity, we have a break of structure. What's this? Mitigation. We mitigated this block in here. So it's the same thing that we took out liquidity, internal range liquidity. We built a little false reaction. We take it out. We come into this feel this order flow here, this mitigation of this block. and then what happens? We come and take external range liquidity. So it's no different, but the difference is this trade here is going to take, oh, what's going on? This trade here is going to take 10 minutes, 20 minutes, you know, but it's absolutely no different. It's all about getting your bias right. It's like, okay, right, that's fair enough. I see the range. I see the range here. I see the range here. You know, why would you take this long? Why would you take this long and not look at this and go, okay, we ran this liquidity here, and then why wouldn't I expect price to come and take out all of this liquidity? Well, I mean, I don't know, but let's just take that and run with it. So I don't know right now why, but let's ask, why would we be bullish? Well, let's go to the higher time frame. Let's go to the 15. This is where you break it down from the higher time frame to the lower time frame. Well, you look at it and go, okay, this, what happened in here? Look, we ran this liquidity right here. We ran this liquidity to the left. We have a strong low. We have a strong low right here. We have a weak high right here. We have imbalance to fill up here. You know, so now we have a strong high, weak low. We've just taken internal range liquidity. Price has pushed up, so it's almost confirmed that we're bullish. You see price has taken the internal liquidity. We haven't taken this high yet. We haven't taken this external range liquidity right here. So we're still bullish, and that's why you put it all together. You break it down from the higher time frames to the lower time frames. Now, if you're trading, this is important actually. If you're trading the 5 minute, 1 minute sort of, and you want to trade a bit quicker, and you want to trade moves like this, then you don't really need to be focused. You kind of want to know roughly where you are on the daily and weekly time frames. So you want to look at them, but you don't want to be like, okay, yesterday we had a bearish close. I'm only looking for shorts, for example. You don't want to do that because it's too high a time frame. Because inside of that daily candle, you're going to get a lot of different bullish, bearish ranges play out, and you're going to get very confused. So your best bet is to trade, if you're trading the lower time frames, is to trade the 1 hour, to use that as your higher time frame. So you use this as your higher time frame, and you go, okay, this is my higher time frame, this is my strong high, this is my weak low. I'm expecting price to come and fill this imbalance before continuing lower to come and take out this external range liquidity. So you would, during Asia session, you would be bullish. So you would take, sorry, it's getting messy now, one sec. You would be bullish. So all you'd be looking for is longs. And then once price comes into here, you'd be going, okay, now we can start to look for shorts. We've taken this out. Maybe now we could start to look for shorts. So let's just play it out. I don't think this day's going to end, to be honest. But yeah, so you can see, look, we have a strong high, we have a weak low. I mean, your bias would be bullish during London until we come and take out this liquidity or fill this imbalance right here. And you can see once we filled this imbalance right here, and respected this. Oh no, sorry, this high got taken. One sec. Let's go to 15 again. Got taken, didn't it? Yeah. Yeah, because this was, yeah, see, this is mitigation of this. So this is strong high, weak low. Strong high, weak low. This took this, and then we dropped. Oh, yeah, that's right. So we took external. So we had a range, strong high, weak low. Price took internal, and then we dropped. We took external range liquidity, and then what happens once we take external? We come for the opposing liquidity or the internal range liquidity, which was this. And that's why that got taken. But then once that got taken, we started dropping and we've broken structure. So now we've kind of taken, let me get rid of all of this. Sorry, I got the range wrong then. So now we are, let me get rid of all of this. So now we are in a range from this high. This is our strong high. This is our weak low. And like I say, this, because the external got taken of this range, from this high to this low, this became liquidity. This became a smart money trap, because smart money see this as, this is the move, right? This is it. They see this as, right, we had an impulsive push down. We wait for price to return to mitigate this block, and then they get in shorts here, stops above these highs, and then drop to come and take these lows. And this becomes, because we took out this liquidity here, this becomes liquidity, or becomes a trap. Yeah, I can't remember what my point was before that, but anyway, I think we'll leave it there. A lot to take in, but all I would say is, if you get anything from this, it would be, go away and do it yourself. Try it yourself. Just try it yourself. Don't worry about anything else. Just focus on, just mark out on the charts, mark out your strong lows, your weak highs, and then just look what happened inside that range. Look what happened. Look, we have a strong low, strong weak high because we ran liquidity, broke structure. Look what happened. Look, we had a build up of liquidity. Price swept it. We mitigated this, and then external, and that's it. Same again. Strong low, weak high, internal range liquidity, channel build up of liquidity right here. What did we do? We swept it, and then we went, took the highs again. So look, we actually didn't take these highs. Oh no, we took it here. Sorry, yeah. And then once we took the highs, what happens is this all became liquidity again. So just go through it and mark up your strong highs, your weak lows, and yeah. Any questions? Just put them in the leave some comments, and I'll try and help if I can. But I should point out, I don't know what the fuck I'm doing. I'm still learning just like everyone else, but I want to try and share what I'm learning, to try and help other people, and some people will go away and do it, and some people won't, and that's fine. But if I can help a few people, and maybe make some trading buddies along the way, and we can sort of go through the charts and break things down together and stuff, and give opinions on EU and GU and what have you. That would be great. But I don't know if I'll release this one because there's been a lot of rambling, but I'll listen to it again and see whether it's worth it. But that's it from me. I hope you all have a good day and a good weekend, and I'll speak to you soon. Goodbye.